Hi, I'm Andrew Stafford with Prevail, here with Kerry Lyon, our CEO of Prevail. We're going to talk markets, inflation, all types of things. We've been asked over the last couple of weeks, what happened in the markets? I mean, you look, a week ago, we had a major drop, lots of volatility. I will say before we get into it, we kind of anticipated this was coming.
Well, I don't know if you're smart or lucky or both, but we have been expecting volatility. I just think people didn't know when and how deep. So why don't you start off by kicking it off by what triggered it was not in the U.S.
That's the crazy thing is our whole markets, the whole world, the financial systems, we've talked a lot to our clients about the globalization. And so ultimately, there's a lot of factors that caused last week's drop, but one of the main factors is we had a situation in Japan where for the longest time, 2023, almost the whole year, they actually had negative interest rates. So when we think about our interest rates here and what the Fed does, the Bank of Japan had negative 0.1% interest rates for the longest time. So how that works borrowing money, I have no idea. But financially, that's the situation they were in. So in essence, people were able to borrow money at near zero cost and put that money in other assets, both in the United States and elsewhere, that had a lot of appreciation. So if you think about your own situation, if you could get money loaned to you at 0%, turn around and make 4, 5, 6, 7% on it, you're going to do that all day long. Yes. And that's what was happening. People were basically raiding the coffers of Japan. So fast forward to March of 2024 this year, they actually went from negative interest rates in Japan to a slight increase, 0.1%. Still not that bad. But what happened is, when you fast forward even to July 31st, when the Bank of Japan came out with a huge increase and from a monetary standpoint and raised from 0.1% to basically 0.25 or 1/4% hike. Now think about what happens in our markets when the Fed does 1/4 basis point or 50 basis points. It sent shock waves through the markets, and all of the people that had been borrowing at 0% now had to cover a cost of capital that they'd borrowed at and had to sell or liquidate positions to do that, which in turn drove the markets down. Now again, there's other data in that, but that was a main driving factor in what occurred.
Well, that day or two following, you had 1,000-point plus drop.
Correct.
So let's talk about volatility, and let's talk about how Prevail views volatility. So we have an investment committee that meets every week. We look at multiple indicators. We started seeing about mid-July the numbers starting to turn, and we watched that many of our indexes that we were watching started to go negative month to date, which, by the way, you always get a little bit of that, but we watched them start to move, and we started moving things if we could capture good gains to cash.
Right.
We got, I think, very fortunate, thankful that we got to the end of August, or at the end of July into August, and we had gone in a lot of our portfolios, captured gains. We could still earn 4%-ish. And we literally were one of the least volatile positions we could be in over the last 3 or 4 years because of our cash positions and capturing gains.
Yeah, we were sitting upwards of 20, 25% in some of the portfolios in a cash equivalent, still getting a return, but not subject to volatility.
And then since that time, we're back trying to allocate capital. You know, we're not timing the market. That's not what we do. But when you have profits, you capture something. So to me, 2 or 3 things were interesting. One, everybody knew volatility was close because the market had gone up so much and companies like NVIDIA and others had had so much gain this year. Okay. 2, there's so many things internationally going on. It's not just Japan. There could be equivalent of 3 or 4 world wars brewing right now between Israel and other places. And so you just get all this kind of uneasiness. And by the way, then let's talk about the other part, the election. Which people, whatever side you're on, it's not a political comment, but the market likes predictability, and right now things are not predictable. So
uncertainty's a killer.
So we still believe the market's going to do fairly well this year. Earnings are still doing pretty well. Companies are figuring out how to cut costs, but it's going to be one of those years that the journey to an okay end, in my view, is going to be pretty choppy and volatile. And then that leads us to this week, actually today, where the PPI came out and it was not bad. In you know, we can go into it if you want to, Andrew, but really what we needed is it to be in line so the Fed had a reason to still considering lowering rates and not see the economy overheating, but yet right in line. And I think it kind of did that.
It did that. We had PPI and CPI that both came in a little bit better than anticipated. which indicates to the Fed, obviously there's a slowing economy. And then you had jobless claims on top of that that came in lower than anticipated, a slight increase in unemployment. All of those things are indicating probably a change in the Fed funds rate.
So, yes, and let's talk about how that could happen. So there is an intra-rate decrease that everybody keeps talking about, meaning when there's not a scheduled meeting.
Right.
And this is all about opinion. I find that pretty unlikely.
Yeah.
So the next meeting is September, and I feel like that the signs are still there that there's going to be a decrease. I mean, everybody's got their own opinion. I think the Fed will start off conservative. I don't think they're going to come in too strong, and probably a quarter point or so.
A 50 basis point would be a surprise.
And most of the analysts that we're reading are calling for maybe 2 to 3 by the end of the year, depending on the data. So I think it still points to a rate decrease. So there's two things that drive our economy in different ways. One is economic expansion. Everybody gets that.
Yep.
And two is credit or cost of credit.
Right.
And economic expansion has slowed, not in a bad way, but slowed. And borrowing money, both the cost of borrowing money and the ability of borrowing money today is much more difficult. So the Fed, if they do a few of those things, it could have a really good outcome in both our economy and, most importantly, the markets.
Now, I will say, all that being said, I just saw a report today. The institutional fear index, the market fear index, was still at what they would consider, let me look at here, make sure I get it right. It hit 22, which is still in an extreme fear range. So I think everybody's real cautious, right? I think that all of this data coming in, and what it goes to show is, just like we tell clients, the markets are complex. And I think being able to be nimble, like our investment advisory committee is, and being able to pick and choose the right sectors as they rotate is what differentiates us from a lot of other money managers.
So today, you cannot be a stagnant or 60-40 money manager and adjusting quarterly. I mean, our committee meets, we are trading every week to try to capture gain. This is one of those times that if you look at the beginning of the year and the end of the year, you may not like the story as much as can you capture gains throughout the year when appropriate. And I think this is, they call it stock pickers. I don't really like that phrase, but I think it's picking good investments, picking an entry price, picking an exit price, and sticking to what that means. Because you can always talk yourself into staying in longer. That's called greed.
Yeah.
And most of the time it doesn't work.
Yeah, and I think you always say it best. The market's going to go up, market's going to go down. It's our ability to be nimble and make money in any cycle.
So a lot going on, kind of nothing too surprising here, but there is a lot. Stay tuned. When we give you an update in another couple of weeks, we'll see if things have stayed the same.